Hello and welcome back. My name is Jonah and I make Forex related content. So, if that's the kind of content that excites you, I implore you to like the video, comment, and subscribe so that we can make more of these videos and share them widely. So, on my previous video, I was talking about forex terminologies, and on that previous video I talked about leverage, and I was as petty as I can be to explain what leverage is as used in forex trading. So if you haven't watched that video yet, please go back. You'll find that video in my channel. So let's continue. So right now I'm going to be talking about uh, bulls, bears, and all that. Those are the kind of terminologies that are used in forex market. So please bear with me. So in forex market, we have two types of participants in forex market, and these two participants, they are buyers and they are sellers. So if you're in forex market, you are actively trading in forex market. You are either buying or you are either selling, and that's the simplest thing I can tell you. So in forex market, there are always buyers and there are sellers. So the buyers of the market, we call them bulls, and the sellers of the market, we call them bears. So when you hear someone say I'm bullish on a certain currency pair, they mean they are buyers, so they are buying. So you hear someone say I'm bullish on a certain currency pair, don't worry, they're just, what they mean is they're just buying. They are buyers of that market. And if you hear someone say they are bearish, that's someone who is in the market and is a seller, so they are selling that market. So another terms that are also used for bullish, this another name is long. So this is also another common term that we use in forex market. I'm long on GJ, I'm long on Euro USD, I'm long on GU. So that means I'm buying that currency pair at that particular moment. I'm long, I'm bullish. So, and for bearish, this one is short. So if I say I'm short on this currency pair, it means I'm selling that currency pair, or I am bearish on that currency pair. So that's it for bulls, market, bulls, bears, going long, going short, bullish, bearish. So I hope you did understand that. So the next thing I'm going to explain is bid and ask. Bid price, ask price. This is also another forex term that is a little bit confusing, but as usual, I'm going to be as petty as I can be to explain it. So don't worry, I have you covered. So bid price, this is let me first give an example with the bank or any forex bureau, and then you can probably come back to forex. But probably with that example of the bank, I'm pretty sure you're going to get everything. So if I have a dollar, let's say I have a US dollar, and I'm looking to exchange this dollar for like I'm in Kenya, so I'm looking to exchange this dollar for Kenya shillings. So the bid price is the price at which the bank or that particular forex bureau is going to buy that dollar from me. That price that the bank, the forex bureau, is going to buy that dollar from me. Let me say buying price from, let me say, bank. So the bid is the buying price they are going to buy from me. And I hope this doesn't confuse you. This is also the price that I am selling to the bank. So I hope you get that. That's the price that the bank is buying from me, and it's also the price that which I'm selling to the bank. So let's go to our next ask price. Ask price. Right now I don't have the dollar that I was hypothetically talking about, but I want that dollar, and I'm going to the bank. I want to buy that dollar, hypothetically. So the bank is going to sell to me that $1. So this is the price at which the bank is going to sell for me that dollar. So that's the selling price from the bank. So, and also not to confuse you, this is also the price that I'm going to buy the dollar. The bank is selling to me, so that's the price I'm going to be buying from the bank. So these two prices, I hope they don't confuse you. The thing is, there is no way bank is going to go loss, to make a loss out of any transaction. So this is the rate at which the bank is buying from me. Hypothetically, if I had that $1 going to the bank and try to exchange this dollar, hypothetically, they are probably let me give a ballpark figure for this explanation. They are going to buy me that dollar. The exchange rate they are going to give me for Kenya shillings, let's say USD, they are going to buy it from me at a rate of, let's assume 112. They are going to sell to buy that one, 112. They are going to buy that $1 from me at the price of 112. After I buy the dollar, I go back to them and tell them, you know what, I actually don't need the dollar anymore. I'm looking to exchange it back to you, give it back to you, and you give me my $1. So that price now is going to change. Now because I'm buying from them, they are going to sell it to me at a price of, let's say, 115 or 114, 114. The bank cannot make a loss on a transaction. So meaning they bought from me at a cheaper price, but when selling it to me back, they want to make profit out of me. So with this example, the thing is, the bid price is lower than ask price. The bid price is going to be lower than ask price because they have to make profit out of that transaction. I hope you got that point very clearly. I hope I was as petty as I could be in explaining that point. So the other thing that I'm going to be talking about is, we call it spread. Spread. What is spread? Spread now is the difference between bid and ask. So this is ask price minus bid price. That is the spread. So you can, in your own words, you can also put it as, this will be now the profit for the bank, because they are going to buy something from you at a lower price and sell it to you at a higher price. So you can also say it's also their profit out of a transaction. So the spread, that's the ask price, you subtract the bid price, you get the spread. So in forex market now, let's talk about forex market a little bit. So in forex market, it's just the same as the bank, because now the broker, now they act as a bank. So they sell to you at a higher price. They sell to you at a higher price, but when you are buying, you buy at a lower price. That's when you are executing a trade. There is no a particular trade, whether it's a buy or a sell, that you are going to execute and it is automatically in your favor. Whether you are buying, and if the market is trending higher and you buy that market, by default there has to be the spread, and that particular trade will have to first start as a loss before it can continue as a profit. Now whether it's a buy order or a sell order, because the brokers, the banks, they have to make their own profit out of the transaction. So I hope you understood today's, I don't want to call it a lecture, today's episode. And if you did, please, the same as always, please like this video, share this video with your friends, allow them to enjoy the same privileges you enjoy, subscribe to the channel, and thank you.